Welcome to today's episode of Peak Market Watch. We speak with market leaders in commercial real estate and related services who have a close pulse on the current market environment. My name is Anton Madley, co-founder and CEO of Peak Financing. I'm honored to welcome Tom Burns, who is a co-founder and partner with Presario Ventures, a private equity firm with a focus on multifamily investments. Welcome, Tom.
Thanks, Anton. Glad to be here.
Yeah, it's a pleasure to have you with us today. Why don't you give our listeners a background about yourself? Obviously, you are a unique real estate investor, so I think it's important that our listeners hear a little bit further back where you started out.
Yeah, I think, I'm always a good example. If I can do it, anybody can. I started my life as a doctor. But found out actually during my doctor training that maybe I ought to be looking at something else besides medicine. So I ran sort of a parallel path and have been building a real estate portfolio for the past 30 years. And so it started slowly, as most things do. Started single things, small units, that sort of thing. And it just grew organically into larger and larger units. And now through basically two different partnerships, I've got a portfolio of medical real estate, pretty large office portfolio. And then my current partner and I we run a private equity firm where we do primarily multifamily development, although we have acquired in the past and probably will acquire again. But that's what we do. So that was a very short 25-year journey with that. So I'm not practicing medicine anymore. I did hang that up in 2021 just because I got too busy doing what we're talking about today.
Yeah, very good. So obviously, if you were at least in the past in that typical high income bracket as a doctor.
Yep.
And a lot of doctors, even though they are in a high income bracket and are really smart when it comes to investing, very often they just leave it up to their financial advisor or on their own and make their decisions on their own, and very often do not make the best investment decisions, particularly when one is in a high income bracket, right? So you wrote a book about that, right? About your experience.
Yeah, the book's called, kind of a cagey title. The book's called Why Doctors Don't Get Rich, which is a bit of a metaphor for the fact that high income doesn't necessarily make you wealthy. Physicians, lawyers, architects, consultants, anybody that puts in a unit of time to get paid can only work so many hours a day. And so you can make a lot of money doing that. But real freedom comes from having passive income that comes in from some sort of investment or some sort of vehicle that's paying you, whether you sleep, vacation, work, or play with your kids. So, and as you mentioned, in the physician world, smart, resourceful people that actually can make excellent real estate investors. It's just that they're often not exposed to it. I had zero business or real estate training through college, med school, and training. I had to go find it myself. These days, it's a lot easier to find. Doesn't make things easy, but it's a lot easier to find the information. So I think a lot more professionals, doctors included, are starting to wake up to the fact that maybe some income coming in while they're working or sleeping might help them out and give them a little more time to control their life, control their future, and enjoy it a little bit more.
Yes, definitely. So you mentioned you started out a long time ago. How did you actually start out in real estate?
Sure. First I was actually still in training, so I didn't have 2 nickels to my name, so I couldn't really buy anything. So I just learned what I could. No podcasts, not much internet back then. It was mostly books, that sort of thing. I talked to people that did real estate. So I started first with education, which is what I suggest for everybody, to learn about it first. And I started talking to people and sort of networking without knowing the term with folks that did it. And by the time I got out of training and got my doctor job and had reasonable income, I paid off a few bills. And the way I learned fastest was I went and bought something. So I bought a small unit. It was a condominium on the campus of the University of Texas. Not a huge purchase. But to me, it was a giant purchase because I didn't know what to do. I didn't know where to get the money or the debt and all that stuff. And I learned it on that property. But strangely enough, the second one went a little faster because I kind of knew what I was doing. And by the third or fourth property, I got pretty good at it. And I bought, over a dozen of those and got to know that market pretty well. So yeah, started simply with no education. But what happens, Anton, is I didn't know anything. I certainly wasn't any kind of real estate professional. I was just a guy who wanted a little bit of passive income. And that first property that I bought, it created $100, $200 maybe of passive income a month. Not life changing, but boy, was that addicting. And I wanted to keep doing that. So that's why I bought more. As you buy more, the people that are selling and the brokers that are the intermediaries in those exchanges, they realize, hey, this guy's serious, he'll close. So they brought me more deals. And partners start coming in wanting to do deals. And so they can get larger. So instead of buying one, I bought 40 at a time. Then I hit a ceiling at one point where I felt that I was doing okay. Again, life wasn't changing much. I was putting all the money back into just buying new stuff, and living off what I made as a doctor, which was a good situation. And I felt like I hit a ceiling. So I went to somebody that was a developer. I was a friend of mine who I'd vacationed with. And I said, I like what you do. Will you teach me? And I always laugh to this day. He goes, you're a rich doctor. You don't need to know that stuff. So anyway, worked for him for a while, actually over a year for free. And he and I ended up developing a large project together. And then along that same timeline, I met my current partner now, who's been, a partner for 14, 15 years and a friend for 21 or 22. So it's just stepwise, step at a time. And all of a sudden ended up wherever I am now.
Yeah, it's a great story, right? So how long have you been with your partner now?
My current partner, I would say 14 years. So
Okay.
we are first, and we've known each other before. We sort of got to know each other, realized we had the same philosophy. And fortunately or not, our first big project started in 2008, 2009. It was a really great time to start a project. So, GE Capital was our debt. It was a 240 unit apartment complex that we were developing. And the Great Recession hit, and GE Capital just said, no thanks. They just left. And so we were left without our debt partner. We found another one, but that's the birth by fire that we had as partners. And so that's when we knew we'd be able to work together, because we had to go through some stuff. And so we've been together ever since. And many of our investors were with me or with him even prior to 14 years ago. So many of our investors are 15 plus and closing in on 20-year investors with one or the both of us. So that's been nice.
Yeah, that's a great track record, right? Particularly since you also went through that downturn with your investors, right? For all of us who have gone through it, we know it was not pleasant, right? Including multifamily, right? So a lot of people think, well, it was only the single family space. The reality is multifamily suffered too, right? It recovered reasonably quick, but it was still 3 years was really a tough period. And anyone who needed financing during that time was in a really tough position. So congrats that you were able to move from GE Capital and find another source, because there were plenty others that couldn't, right?
Yeah, there were people with good performing properties that just couldn't get debt at the time. So, there were ads for 2 months free rent and a flat screen TV if you'll lease our apartment. So those, life is waves. Those days have a chance of coming back at least. So we all want to be cognizant of that.
Yes, that's why whenever someone just has 2 or 3 years left on their commercial mortgage, I think it's that period back then is a good lesson, that when the financing dries up and you have to refinance right during that point, even if you have great cash flow, it's still tough, right? So that's why it's important to always think ahead, to have that cushion in terms of timing, that you're not caught, not because your property is not performing cash flow wise, just because the financial markets are not on your side at that point, right?
Right.
Yeah. So you did development then, but I think you also bought some value add properties then, right? As obviously the market was pretty tough to own not just single family, but multifamily. The advantage was that if one had financing and equity, it was a great time to buy existing properties at that point, whether it was 2010, 11, 12, right?
Yeah.
So you bought properties at that time too, right?
We actually didn't buy much in that early period for a number of reasons. One of which is we wanted to make this was our first big project, and we wanted to make sure it did well. So we really, quite honestly, put our focus on that project. Kind of pushed other things to the side to make sure we took care of our investors, make sure we took care of the debt and the property. So there was a sort of a dead period, if you will, where we didn't make any other acquisitions, and it was just for that reason. We wanted to make sure that project did well. As things moved on, we started getting back in the game, and we did buy some value add.
Yeah. Okay. So that's good to hear that you didn't jump in, even though the opportunity was there, just to make sure that your existing development had all the attention. So that's great to hear, and I think that's probably a good lesson for many deal sponsors today who run from one deal to another and do not really have their in-house infrastructure in place to support all these acquisitions at the same time. Right?
That's a good, and we didn't. And, so we wanted, many of our investors were people that had invested with us before, and we're going into this, recession. And so we wanted to make sure we took care of them. And then, of course, the recession ended and the property did great. So we looked smart. We just timed it right. But it was important for us. We've still got all those investors, and they invest in each of our new projects typically.
Mm-hmm. So did you sell that property once it was built and fully stabilized?
Yeah, that's a good question. Especially these days, the way the market is, we actually still own that property. So it was a HUD deal. So we had 40-year fixed debt, and interest rates were dropping at the time. So we did what's called an A7 non-cash out refinance. So we lowered the interest rates. That was one refinance. And then as time moved on, we did a cash out refinance, and we're at a point where we could either refinance or sell. And probably at this point, we hope to sell the place, but it's got some other moving parts. It was one of the first public-private partnerships of its kind. In fact, it was the HUD deal of the year in 2010. So
right.
It was structured in a way that had not been structured before. They do a lot of that now. So we still have that. So we've got a few other stakeholders that we need to take care of, but hope to sell it after 13, 14 years.
Yeah.
That's performed very well. Very well.
I can imagine. Yeah. Obviously, long-term financing, cheap financing initially, right? And then being able to refinance again into cheap financing with another HUD loan, right? So that's pretty attractive. A lot of people obviously steer away from HUD loans because of because it's extremely time-consuming to actually go through the process, right, from application to close. Back then, it may have been a little bit faster, but right now in the current environment for a construction loan, you're likely well above about the 1 year mark from application to close. And even refinancings, when they were taking place maybe in 4 or 5 months pre-COVID, now they take 12 months or sometimes even longer, right?
Right, that's correct.
Yeah. And you weren't concerned about the high replacement reserves and all that, as well as all the other restrictions or requirements that are put on you, like when it comes to to CPA requirements, as well as property management requirements and all that. So you were comfortable with the additional cost associated with a HUD loan.
Well, looking back, and we will still utilize HUD. We're not as much now because of speed, and so we use a lot of commercial debt now. But back then we were just happy to have a loan, so we were thrilled. We would have done whatever they asked us, but it was good for us to learn. We actually didn't know much of anything about HUD back then, and that's where we cut our teeth and learned about it. So you can only distribute twice a year. You've got to have third-party oversight and audits of the books, which I think is great for the investors anyway, and great for us. It did cost more. The HUD loans are a little more pricey with what you've got to go through, and it took us forever to get it. The project itself had some cost overruns just due to the fact that we had the municipality involved. So that was fun. But once you get through the HUD brain damage, which I agree with you, it's a year now. You've got to really be patient and want that loan. But you get 41 years and 10 months of fixed rate, right? And 20 of those or 20 months of that are 20 or 22 months of interest only. So it's a good loan once you get it. And if you can fix your interest rate, and in this particular property, we had 100% tax abatement. So between interest, taxes, and market, we fixed two of the three variables. So that's why it's been such a nice project. We provided some affordable units in a very nice area and a very nice project. So it worked out great for this instance, great for the city, great for us, great for our investors. We have not applied for a HUD loan in quite a while. And in fact, we've sold some HUD projects that, we spent that 4 to 6 to 8 months getting the loan, and then our projects got stabilized and in some respects pre-stabilized, and we got crazy offers, as you know, the way the market was over the past year. So we sold some HUD projects with rather large prepayment penalties, and it was still a huge return for the investors. So you're right. Speed wise, it's not the best product to use right now. Nice to have once you got it though.
Yeah. That's definitely true. Yeah, particularly for newer properties, right?
Right.
Yeah.
Well, and they're assumable, and so we're looking at a property now on an acquisition, and being at least known to HUD, we're good buyers, and so you can assume a HUD loan for 50 basis points. It still takes time, but you can assume it if you've got deep enough pockets to handle the equity requirement.
Sure, absolutely. Nice. Yeah, definitely. Yeah. So what did you do on the value add side once you had the time to go into those?
Nothing different than probably anybody else. Countertops, floors, appliances, and cabinet fronts, that sort of thing, the typical thing. We didn't do a lot. Our DNA was kind of built on the development. So there was a gap. Again, there was another gap in the middle of between 2010 and 2020. There was a bit of a gap. My partner and I had a family member that was quite ill, so we sort of slowed down. And so we did that. We sold all of those, sold all of our assets that are outside the state of Texas, and decided just to concentrate in Texas, primarily on development, but always with an eye for acquisition. In fact, one of our directors has close to 10 years of acquisition experience with a $1 billion company, and that's sort of our acquisition arm, if you'll have it. So we're seeing a few more now. We're underwriting enough now that we're starting to see some that are reaching the investment committee and deal flow. So a little bit more acquisition, more on the yield play side than on the value add.
Yeah, that's good to hear. Obviously, over the last few years, particularly the last year and a half, it just didn't make sense if you have development experience in the pipeline to even consider buying a so-called value add that is above your development cost, right, for a new project. And it's just that liquidity and the low interest rates was just attracting so much equity, and everyone just was jumping in, right? So obviously it makes much more sense once you have that development experience and you know that you can perform to build something brand new, and you have that quasi value add piece right built in from the get-go, rather than hoping that you can achieve it with buying an older property, right?
Exactly. And then neither one's better than the other. They're just different. They're just different ways to get to the same destination. But at least for us, our skill set was more entrenched in the development world. And you're right. Over the last 12 to 18 months, people were buying at or above replacement cost, and our value add essentially was buying a piece of dirt, and our value add was putting improvements on it. And so we knew that there is just a certain yield to cost that we knew we were going to have a spread in there. And so that's what we did. But things do change, and things certainly have favored development, just maybe over the past year. And I don't know, maybe it was an equal scale before that. But I think things might shift back, which is why we're looking at a few acquisitions right now.
Yeah. We certainly have seen on our end many more opportunities that came to market well above what one would expect, where they had offers just 2 months ago well above a whisper price, and now we see that very often deals trade actually below the original whisper. So there's certainly an opportunity for someone who knows how to identify deals, that it's a little bit easier to find transactions that make a little bit more sense. It's still expensive, but at least we see a little bit of an improvement there.
That's good to hear, because I know you're tapped into that. That's good to hear.
Yeah. So you, other than the multifamily side, you also do build to rent, right? That's another piece that you're doing now. Build to rent, it's kind of funny. It's not something that is brand new really as an asset class. It's just that doing COVID-19, somehow someone came up with that term, and now everyone is using the term, right?
That's right.
So what are you using in that space?
So we'll typically partner with somebody on this one. That's kind of more on the PE side for us. And so we'll bring the debt and the equity and do whatever we need to do. But we started looking at it probably 3 or 4 years ago, and it takes us time to develop relationships, at least for us. So we don't like speed date. So wanted to make sure we had folks that would fit into our culture and fit for our investors. And we've identified quite a few of those. And we have one project going on down in Houston. Most of I don't know, for your listeners, I'm in the state of Texas, and the majority of our projects are along an interstate called Interstate 35, which splits the state in half and goes from Mexico to Minnesota. And so we stretch from North Texas to South Texas. It's where most of our projects are. So the black sheep is over there in Houston, which has got some opportunity to it if you understand Houston and can maneuver around the strange land, the strange incentive, the way they. I'm blanking on the word, but they have interesting rules in Houston. So you'll have
zoning perspective.
Zoning, thank you.
Right.
It's my Alzheimer's. It kicks in once in a while. So strange zoning rules. So we've got a built to rent project going in a nice neighborhood up northeast Houston, and probably we'll do a sister project next door with the same group. And then we're looking also down in the Baytown area and some stuff in Central Texas. So yeah, we like the build to rent. Typically they're mostly designed for institutional takeout. In the end, they still have an appetite for that. They're all designed to sell, at least the ones in Texas. And however, we try to do them with individually platted lots if we can, if that fits for our partner, because that does give you at least another exit strategy if things get rough.
Right. Yeah. So at least you have that alternative, right, if necessary. Yeah.
Yeah.
Yeah. Very good. So in Central Texas, I think it's only that San Marcos area in particular is in everyone's mouth for build to rent. It sounds like that's kind of the hotspot for build to rent target. Is that also an area that you're looking at?
Yeah, yes.
Yeah.
Maybe soon.
Yes. So obviously the good part, I would say, one, I don't know whether you're concerned about competition there or overbuilding. So I think that is might be a little bit of a concern in some of these pockets. The good news is that institutionals love that area, right? So,
Yeah.
so from a takeout perspective, you almost guaranteed as long as the market continues to be interested in it, that you are able to find strong interest on the institutional side.
Yeah, Central Texas is not recession proof, but it's a little bit insulated, typically kind of last in, first out, not as deep. And so I think the institutionals and the sovereign wealth funds understand that or believe that, whether it's true or not, that's their thought process. So a lot of them like to be in Central Texas. So anywhere between Austin and San Antonio is typically pretty strong. You can't just go stamp a development any place you want. I mean, we still do the CoStar reports and look for the need. And so as long as there's still a strong supply need, we'll do it. And at least last data I had from our folks was that still in that San Marcos area, the need was still there. So I'll have to check back with them and see if it's still there. But yeah, very popular. New Braunfels, San Marcos, San Antonio, Austin. It's crazy.
Sure, that whole corridor, right?
Yeah.
And on top of that, obviously, we have everyone from Silicon Valley seems to move to Austin. So,
Anton, the craziest thing I heard within the last few weeks, the Metro, Austin, Texas Metro added 97,000 jobs in the 12 months prior. That's just a staggering number. You've got certainly the Tesla factor and the Google and Amazon. Everybody wants to be here, which is great for business.
yes, absolutely, right. There is no doubt about that. The disadvantage obviously is that not everyone has such high-paying jobs that they can afford the big homes, and I think that's where multifamily and the build-to-rent segments only are an important piece to the puzzle, right? So, and I think that's why everyone loves that Central Texas market, because everyone sees the Teslas and the Samsungs and everyone else putting in these massive plants, right? That employ tens of thousands of people at the end of the day. Yeah.
Yeah. Jobs and housing that's typically that's sometimes too expensive to afford. That's pretty good for the rental market.
That's definitely the case. Yeah. So being in Texas, obviously, property taxes are a big issue, right?
Yep.
So how have you been able to deal with that? You mentioned for your project that you started out, right, during the Great Recession, you had tax abatements, so that you were lucky there. But I assume not all of your projects are so lucky that you have tax abatements.
That is a fair statement. Yeah. And so we are, there's only so much you can do. Of course, like everybody, as we fight the taxes every year, but these days you do what you can, but you're still going to get significant increases. So, we don't, certainly if we're doing a projection, we certainly don't play with the pro forma. We take 100% of the mill rate and the potential valuation. We typically will look at how other similar properties are taxed and valued. And typically if we use 100%, there's a bit of a cushion in there, but yeah, they're going up. And so numbers are numbers. Numbers will tell you what to do. So we put the real numbers in there and see if it's still a feasible project for our investors and for us secondarily.
Yeah, good.
They're going up like crazy.
Yes.
Like crazy. I didn't mean to interrupt you, but I at least on the residential side, I mean, the commercial side's nuts, of course, but on the residential side, they're going up 200 and 300%. And those are real numbers from folks that I've talked to. And probably my commercial stuff is, I felt like I didn't get hurt too bad because it only went up 50 or 60%. So it's crazy. Crazy.
Yeah, right. And it's crazy that one needs to refer to only, right?
Yeah. Pretty scary.
percent plus in the same sentence. Yeah.
Yeah. The taxing authority just went nuts on valuations this year. So I think a lot of people will be able to fight them with appraisals and some other things, but I mean, it still doesn't mean that it'll just be less than the, gargantuan tax rates that they're going to have. They'll just be really big.
Yeah, that's definitely the case. Yeah.
Yeah.
So being on the development side and having seen it over a long period of time in Texas, where would you say are your pain points mostly now with COVID related on the construction side?
Yeah, it's COVID, and it's COVID, supply chain, and interest rate right now. Certainly for the past year or more, we've had the supply chain issues. Simple stuff like we couldn't get paint, even a paint that was close to the same color. We would have taken anything. So that's just a tiny example of it. It delayed various projects, and it's certainly delaying some others. And so that's one thing. The delays, and certainly delays cost money because there's a cost of capital. But now we're having difficulties. You used to get a bid, and it was good for 60 days from your contractor, and of course you could get a GMAX contract on the HUD deals and non-HUD deals. Now it's really, you really can't. We have one that says they can give a GMAX contract. We'll see. It's not signed, but nobody's doing that, and your time frame is down to 21 days. We'll give you a bid. It's good for 21 days, and builders telling you that costs are sometimes going up 1.5 points a week. So that being said, we're doing a couple of things. We're putting in a significant amount of contingency now for those kind of increases. Also having to put in a contingency for interest rate increases and trying to get anything fixed that we can. And often construction debt, if it's not HUD debt, your debt's floating, and so that bothers us right now. Sometimes you can buy a cap. That cost has gone up astronomically. So we are now we're number one, reevaluating every project that we have in the pipeline. We were scheduled to deploy $80 million this year. Not certain that that'll happen or not. Nothing's been canned yet, but we're looking at that to make sure that those projects are still real, they're still viable. And we've slowed down because we're typically acquirers of land. So we have a number of tracts of land, which have been good investments. Obviously, they've gone up in value. So you buy something at $8,000 a door. Now I'm hearing $20,000 and $30,000 a door for land.
It's crazy.
So that's what we're doing. We are putting a very sharp pencil to every project. A lot of value engineering from our contractors is just required. A couple hundred basis point sensitivity table on interest rates. Cap rates, not, certainly some expansion in cap rates, but they're not as always correlated with interest rates. So we do have cap rate expansion in there, but not on the range of 200 basis points. So we're just trying to do what we can, be conservative, and see if it still makes sense. Because if it can hold its head up and hold its debt coverage, then we're pretty confident that inflation is going to do its thing. And this is a hard asset that there's been value add to. So we think it's going to be good for those that own it in the long term.
Yes. Yeah. Good to hear that you're working on that. On GMAX side, right? It's I look at them, and I have my own development experience. I look at them almost like a safety net that you think you have a safety net, and at the end it's very likely that that safety net will be broken. Right. So unless you have you can be 100% sure that you don't have any change orders, right? Right. The fine prints are really where that ultimately trigger it. Plus, having a large project without change orders is almost impossible, right? And with the supply chain also being an issue, you may have to come in with change orders even if you don't want to, right?
Right. Yeah, I don't think anybody's even built a treehouse without change orders. So you're right. So it's challenging right now. Things can still make sense, and you certainly don't always want to count on rents increasing and values increasing. And so we try to do it on today's numbers. We're having to project a little bit of increase in rent. And so we're stepping back and looking each week. Does this make sense? Where
Yeah.
can we be? Because you can't, there's some things you can't fix, and you can't predict interest rates. And so that is one thing on the development side that's brought in an element of risk, at least in our mind. And so we have to try to decouple that risk with some sort of hedge, or at least our education and some conservative underwriting, real conservative underwriting.
Yeah, that's definitely the case. To be fair, when we look at that, roughly 90%, at least in all the major markets, of existing properties are acquired with bridge loans that have usually 3-year terms plus 1 year plus another year extension.
Yeah.
They are in a very similar boat, right? Where they also have to anticipate whether they can sell the property in year 3 and or refinance. And obviously, even if you want to sell, if interest rates are significantly higher, that buyer has a higher interest cost, and the cap rates might actually go up, right? So,
Right.
So the reality is, most buyers today, whether you're a developer or whether you're buying an existing property in multifamily, most of them are really working with that roughly 3-year span, and need to anticipate what is happening in 3 years out, right? So,
right, and be prepared for it. Because I think, I still, real estate doesn't always go up, but certainly it's a good, in an inflationary environment, it's a great place to put your money. Inflation is going to work for you if you're in your real estate at the right numbers. And so I think it's just incumbent on all of us, whether we're buying or building, to just make sure we don't count on getting lucky. We'll make sure we have the right numbers in there.
Yes, definitely. On the development side, have you also attempted to shrink some of the units to get the cost down, but still being able to deliver the same amount of units, or not?
That's a good thought. We have, units were kind of expanding for a while now. They've actually just been on a curve. They've kind of been shrinking anyway. And so, not particularly for a project, but I will tell you one project that, is in its various places on its timeline. We did have to sit down and, remove metal awnings, believe it or not, turn an asphalt parking lot into a concrete parking lot. There was a time where I don't know if it's still that way, but concrete's cheaper than asphalt. I like concrete better anyway. So small value engineering things like that, taking the clubhouse down to 1 story instead of 2, or taking the fancy roof that the architect drew because it looked really cool and just turning it into a functional roof, that sort of thing. So we've not actively shrunk the size of the units, but I think they've been coming down anyway.
Right. Yeah. Mm-hmm. Yeah. Very good. So, knowing where we are today, where do you see things are going? Obviously, nobody has a crystal ball, but you still need to plan, right? So what's your view of where you're going this year and next year with Presario?
I certainly think with the demographics and the liquidity and the difficulty of owning your own home, I think the rental market itself is going to continue to show rent increases in the good Sunbelt markets, in the good Sunbelt metros. So we feel good about that. Whether we can marry the economics of buying or building something to meet that need remains to be seen. I'm assuming that's so. So we certainly want to stay in the market. We want to, we don't want to have what do they call a single point of failure. We don't want to bet the farm on one thing. So we're certainly going to have multiple projects, a couple of different asset classes. Although build to rent and multifamilies, one asset class, just 2 different sides of the same face, I guess. But so we're going to just try to be in areas where there's good population growth. Everything you hear from anybody else that's buying.
Sure.
We think we'll be okay. We think we're going to slow down. COVID certainly slowed things down. Then the pipeline the clogs came out of the pipeline, and this is last 12 months has been a crazy busy year. I suspect we will, much like we did on that first project you and I talked about, my partner and I focused on it. We are going to focus on the properties that we have now, the land that we have. If we have to go into a land hold situation, we'll do that. But we certainly don't want to sit on our hands. You know, we want our money, and we would think our investors would want their money in some sort of hard asset. So we hope to produce something for them to put their funds and let it grow with inflation. I think interest rates aren't finished yet. Macroeconomically, I'm not smart enough to figure out what's going to happen as those rates go up, but I think they've certainly projected and indicated that they're going to go up a few more times. So, you know, I think back to when I bought my first house. You know, I got a loan for 10% on my first house. I was thrilled. It worked. So they work, because as things do start going up, and if and you know, cap rates will eventually have some expansion. So it all evens itself out. If it doesn't, people aren't going to build. So we're going to stay in the market. So we know when things turn bad, we know when things turn good. We'll be ready. We'll be ready for both.
Yeah, very good. And you are definitely in one of the best, if not the best market in the Sun Belt, right? So I think there are definitely big differences from one Sun Belt market to another, particularly when we look at Austin and south of Austin along that corridor, right? As you already said, right? Austin, the greater Austin area, adding 90,000 jobs. It's just unbelievable, right? So there will definitely be some winners and losers even in the Sun Belt, right? But yep. I think you're in a very good spot there. Yeah.
Yeah, we like Texas. We like areas of Florida, Central Florida. Really like that as well. A lot of growth there, a lot of industry and tech in those areas too.
Yes, yeah, definitely.
Where the jobs are.
Yeah. Very good. So I really appreciate that you came on and shared your wisdom and background, right? So that's very valuable for our listeners. How can our listeners, first of all, get in touch with you, but also maybe you just can direct them how they can get your book in the easiest way?
You bet. So I got too many websites, probably out that too. Let's the website, go to rich.life, and they can get a hold of me at tom@richdoctor.com. And through either one of those, you can get to me, and you can get to the website. And through the website, you can find the book. It's on Amazon. It's called Why Doctors Don't Get Rich, but it's not just for doctors. That was my one pitch. I'm not much of a salesman. I don't make much money on the book, but it's good. It's a good book to read. But you can also get to my company, Presario Ventures. There's a link on there where you can kind of get our newsletter as well and get on the investor list if you wish to. So we're not very spammy. We just put out education and an occasional deal.
Yes, so appreciate that. Obviously, if someone wants to invest with an experienced developer, right, a multifamily investor, there are many options out there, but I think there are not that many that have been in the business for as long as you have and your partner, right? Which I think, particularly in the current environment, is more important than ever. When everything moves up, it's easy to be successful, but as things get a little bit tougher, it's important to rely on individuals and leaders in a firm that actually have gone through the tough times before, right? So I just would kind of like to toss that in there, that you certainly get that with Tom and his team and Presario. So thanks again, Tom, for coming online with us. That was great, and sharing your wisdom, and wishing you good luck in these crazy times, right? I think there will be a lot of opportunities still going forward, and wish you a lot of luck with them.
Thanks, Anton. Yeah, there's opportunity in good times and opportunity in bad times. There's always something around the corner. You just need to know where to look for it. So I appreciate you very much. Thank you.
Yeah, thank you, Tom.